And here we go, and we're going to continue on and talk about interest-bearing notes. Keep in mind there are some various things that actually come with a note. When a note is in place, there's a contractual obligation to honor this note. It's a promissory note. You're going to have the maker, you're going to have the payee, maturity date. Typically, there's going to be some type of a defined interest that is laid on it. That is an interest bearing note. We'll talk about the ones that are zero interest bearing here after a bit in this exact recording, but let's start with Castle National Bank. They agreed to lend $100,000 on March 1st, 2017 to Landscape Company. If Landscape signs a 100,000 6% 4-month note, when they actually receive the cash, the first thing they have to acknowledge is they had an increase in assets. So they debit their cash. They also have a $100,000 increase in their liabilities of notes payable. This represents that in 4 months' time, they will honor the note and pay $100,000 back to National Bank. Keep in mind with issues such as notes payable that are in the current, meaning that they are 1 year or an operating cycle or less, that we don't take into account the time value of money on these because it really is considered negligible. Now, let's assume that they prepare their financial statements semi-annually. So they're going to need to recognize their interest expense and the amount of interest that will be payable at the maturity of the note as of June 30th. Now, recall they entered into this on March 1st, and it is 4 months. So the maturity date on this is going to be June July 1st. So to calculate interest, we start with principal. We multiply that by the interest percentage. So this is 100,000 multiplied by 6%. And then we multiply that by the fraction of time it applies to. So this is 4/12 of a year because when you are given an interest amount, that is an APR, an annual percentage rate. So the interest that has accrued is $2,000. So we'll recognize our interest expense in accordance with the matching principle. And we'll recognize that we have $2,000 in interest payable that we'll be paying out with the maturity of this loan. Now, on maturity, 1 day later, July 1st, they have to pay the full note and accrued interest. So we are going to have notes payable decreasing by $100,000. We're going to have our interest payable that's going to decrease by the $2,000 in interest. And then we're going to have $102,000 worth of cash that we are going to pay out to Castle National Bank. Now, the previous examples, those with interest bearing, are really very simple. It's just making sure that when you do these interest calculations, that it is principal times interest rate, which is stated in APR, multiplied by the fraction of time, and getting that fraction of time correct. Now, the zero interest bearing notes, those are a little bit more complicated, right? So, a company may issue a zero interest bearing note for any number of reasons. What that means is that the note itself does not explicitly state the interest rate on the face of the note, but interest is still being charged. At maturity, the borrower has to pay back an amount greater than the amount of cash that they received. So they say, I will pay you $102,000 in 4 months if you give me $100,000 today. So, in other words, they receive in cash the present value. Think back to the time value of money and how we do that discounting back. The amount of the difference between the face value of the note at maturity, so in this case, the $102,000, and the upfront amount, the amount that you were given, the $100,000 in cash, that difference represents the interest that is going to be charged or discounted by the lender for the term of the note. So we're using the same amounts, you'll notice. We have Landscape Company, Castle National Bank, they're going to pay $102,000 in 4 months on a note. The present value of the note is $100,000. So they receive $100,000. Landscape Company does. They increase their cash by $100,000. Now, they know due to the contractual obligation that they will have $2,000 of additional payment on it. This we will load to discount on notes payable, and then we'll recognize the full amount of notes payable at $102,000. Now, the discount on notes payable being a contra account to notes payable, and so it'll be subtracted from notes payable on the balance sheet, is where we hold this representation of the interest expense that's going to be chargeable to the future periods. Because that $2,000 in interest that will be paid in 4 months has yet to be earned or incurred. Your discount on notes payable will represent the cost of borrowing. The cost of borrowing is also often referred to as your interest expense. We will debit interest expense over the life of the loan to equal the $2,000. And this is the interest that is chargeable to the future periods. So as we go through a period of time, we will recognize this pro-rationally, much as we would, such as the discount on bonds payable, or, for example, how we amortize over time. We would follow the same situation where we would allocate it to the periods as necessary. When we go into class, I will find an example and I will show you how this will work from beginning to end. But this is just the quick and dirty highlight on zero interest bearing notes. Now, before we move into some of the others types of current liabilities, we're going to go ahead and talk about Orion Company and give you some examples here. And this relates both to accounts and notes payables from 2017 transactions at Darby Corporation. So Darby purchased inventory from Orion Company on account for $50,000. They record the purchase gross, and they use a periodic inventory system. Then on October 1st, Darby Corporation issued a $50,000 12-month 8% note to Orion in payment of the account. And then they borrowed $75,000 from Shore Bank by signing a 12-month zero interest bearing $81,000 note. So our transactions on here are kind of a variety of them. First, we have the purchase of inventory from Orion Company. So with that, we received $50,000 worth of inventory. So we have purchases went up by $50,000. We used the purchases account because we are using the periodic inventory system. And then we have accounts payable of $50,000. We're recognizing it at $50,000 because there are no terms, and this is recognized on gross and not net. Now, we issued a $50,000 12-month 8% note to Orion in payment of the account. So, what we said on October 1st is that we will pay this off in 12 months at 8% interest. So, our accounts payable decreased by 50,000, but our notes payable increased by 50,000. So, we took this from an accounts payable to a notes payable, showing the difference in the terms and the situation regarding this $50,000. Now, it is 12 months, so it is within 1 year. So this is probably still teetering right on the current liability side. However, if this had been an 18-month, then it would turned it into an 18-month notes payable, which would be a long-term notes payable. Now we're going to need to calculate the interest because we're going to have some period of time. So at the end of the year, that's 3 months, the month of October, the month of November, and then the month of December, we need to accrue our interest. So we take 50,000, we multiply it by 8%, and then we multiply it by 3 divided by 12, representing 3 out of 12 months. And that tells us we have $1,000 worth of accrued interest. So at the end of the year, we would have an interest expense of $1,000, and we would have interest payable of $1,000. Now, on October 21st, we also borrowed $75,000 from Shore Bank by signing a 12-month, zero interest bearing $81,000 note. Now, you notice it says zero interest bearing $81,000 note. That means that at maturity, we will be paying $81,000, whereas we will be receiving $75,000, which is the present value. So we have cash of $75,000 that rolled in. We have a discount on notes payable of $6,000. This is the difference from the $81,000 that we will pay in 12 months and the $75,000 that we receive today. This represents the cost of borrowing over the term of the note. So this is over the 12 months. And we have a notes payable of $81,000. Now an interest calculation. We're again going to have to recognize on December 31st, 3 out of 12 months of cost on borrowing. So we look at the discount on notes payable of 6,000 and we multiply it by 3 divided by 12. That gives us a $1,500 interest expense and then discount on notes payable of $1,500 will have been allocated. And the next thing we'll go into is we'll be talking about dividends payable and a couple of other topics as I go into the next set of slides. So we'll have dividends payable. We'll talk about customer advances and deposits, a little bit about unearned revenue, and then we will break at that time for another set of slides. So I will see you in the next lecture starting with dividends payable.